I think the major reason is that we have hit a new record in terms of one-day increases in the number of COVID cases around the U.S., and investors are getting very worried that this second round could end up being more severe than anticipated. I think that investors have said this stimulus package we might get, but it'll happen after the election, not before the election. Combine the lack of stimulus with the COVID spike, and I think investors are also selling off because the implication is that there is now a greater likelihood that President Trump will not get reelected. And if you recall the presidential predictor, whenever the market has gone down from July 31 through October 31, the president has been replaced 88% of the time. I think that there's uncertainty just abounds because nobody knows for sure whether there will be a very dark blue wave, meaning that you see a significant majority of people voting for a Democratic president combined with a strong majority in both the House and the Senate, or whether you get a light blue wave in that you only have a 1 or 2 majority in the Senate and therefore not enough to pass legislation should some of the moderate Democrats not want to go along. And also there's still the possibility that the Senate remains Republican. So right now I think investors are just very concerned about the variety of outcomes, and if there is that deep blue wave, does it also imply that investors will sell out in 2020 in order to lock in the lower tax rate? If we end up with a strong blue wave, then I think that even though we might end up with a down market in November as some investors decide to take profits while the tax rates are lower, historically the market has done very well under Democratic presidents in general and under Democratic trifectas in particular. Trifecta meaning the presidency and both houses of Congress are Democratic. On average, the market has gained about 10% versus less than 9% for all years, and the batting average, or the frequency with which the market rose, was the highest under that scenario, meaning a Democratic trifecta. Well, I think with the market selling off as sharply as it did today, and also knowing that in the 5 days leading up to the presidential election, the market gained about 2.5% on average, rising 17 of 19 times, so a pretty good batting average. And then also realizing that once the uncertainty has concluded, then the markets do tend to do fairly well. Maybe today's not the day to jump in, but it probably is fairly soon. We had 2 instances in which the market went up, but the president was not reelected. 1968, I think the disruptor was the Vietnam War, and in 1980, the disruptor was the Iranian hostage crisis. Back in 56, when the market went down, but the president was not replaced, was because of the Suez Canal crisis and the Hungarian uprising. So yes, we could get a geopolitical exogenous event, and in this case it being COVID-19, to serve as a disruptor to this presidential predictor. Well, I think that investors shouldn't be looking for 1 day, 1 week, or 1 month down the road. They really should be looking 6 months, 12 months, multiple years down the road, or at least that's how we make our investment analysis. On October 31st, we move from what's traditionally known as the sell-in May period, in which the market usually is cautious and the defensive sectors do well, moving into the November through April period, in which the market typically does very well. Actually, it's the best 6 months of the year on average, in which the cyclical sectors such as technology, consumer discretionary, industrials, and materials tend to be the better performers. So if we do end up with some sort of a blue wave that then leads to an increase in infrastructure spending and just in general a support to the overall economy, then I think we will see that kind of seasonal rotation back into the cyclical sectors take place.